looking at the market today, um, are we seeing a falling trend and flashing sell signals, or is this actually a strong buy that is just, massively undervalued?
Yeah, that is the exact question right now.
Right, because you are looking at a classic crossroads, and today our deep dive is zeroing in on one specific heavyweight, which is Charles Schwab, ticker symbol SCHW.
A massive player.
Huge. But before we jump in, make sure to like the video, subscribe to our YouTube channel, and leave your feedback in the comments. I mean, it's compulsory if you want to keep getting these insights from us.
Definitely. Do not forget to comment.
So let's set the scenes for you. Today is April 16th, 2026. The stock is currently trading right around $94.97 a share.
Right.
And it's down like 5.27% on the day following its Q1 2026 earnings release.
Yeah.
Which brings us to this massive contradiction.
Yeah, the paradox here is wild because the company actually reported an adjusted EPS beat.
Wait, they beat earnings expectations.
They did. They stepped over the bar Wall Street set for them, yet the market just violently dumped the stock anyway.
That makes zero sense on the surface.
I know. Obviously, we're navigating a broader market retreat right now, but for Schwab specifically, the short-term sentiment has just been completely hijacked by concerns over elevated operating expenses.
So the underlying profit victory is just, being overshadowed by fear.
Exactly. People are terrified of how much it costs to run the business.
Which is why our mission today is to figure out what's really happening beneath the surface of this stock. We're going to unpack the financials, the technical analysis, and this really intense bull versus bear debate.
Are we looking at a value trap or a genuine discount? That's what we need to figure out.
Exactly. But really quickly, I have to remind you that this deep dive is strictly for educational and entertainment purposes.
Yeah.
We are looking at data, but this is absolutely zero financial advice.
Right. Always do your own research.
Okay, so to understand why the stock dropped over 5% today, we first need to look under the hood at the company's financial engine, right? Like, are the fundamentals actually broken?
Well, let's look at the massive numbers from their full year 2025 income statement, because total revenue was a staggering $23.92 billion.
$24 billion. Wow.
Yeah. And from that, they cleared a net income of $8.85 billion.
That is massive.
It is. And the momentum was accelerating. If you look at Q4 2025 specifically, revenue actually rose 19% year over year to a record $6.3 billion.
Okay, let's unpack this. Because if I'm just looking at the sheer scale of those numbers, you were describing a financial fortress.
It really looks like one from the outside.
Right. I mean, 19% growth on a base of billions of dollars is not normal for a legacy institution.
No, it's not. And the balance sheet for Q1 2025 backs that up too. They have $491 billion in total assets.
Almost $500 billion.
Yeah.
Yeah, against $441.7 billion in liabilities. Plus, their operating cash flow for 2025 was over $9 billion.
Meaning they just have a ton of cash lying around.
Exactly. They are sitting on a massive $69.66 billion cash position right now.
Okay, so I have to ask the obvious question here. If they have all this cash, record revenue, and billions in net income, why did the stock hit a 52-week high of $107.50, but is now bleeding down to $94.97?
Right. It's drifting way too close to its low of $73.76.
Exactly. If this financial fortress is so strong, what is going on?
Well, there is a leak in the fortress. Like I mentioned earlier, investors are spooked by elevated operating expenses.
A machine makes money, but it costs too much to run.
Exactly. The core issue is that maintaining all that infrastructure, the tech, the cybersecurity, the talent, it's just getting way too expensive.
So since the long-term financials still look solid, this panic today must be driven by short-term momentum, right? And internal behavior. Yeah, we have to look at the charts and who is actually buying and selling.
Here's where it gets really interesting. Just looking at the technicals, the stock is trading roughly 13% below its 50-day moving average.
Which is severe weakness. The short-term trend is undeniably bearish.
Yeah, break down the indicators for us.
Sure. So the RSI 14 is sitting completely neutral at 50.24.
Okay, so no extreme oversold signal there.
Right. But the MACD is negative 0.08.
Oh, wow.
Yeah, that is a clear bearish signal. The stock has just broken below key moving averages, the SMA 50 and the SMA 100.
So it's basically forming a falling channel.
Exactly. And right now, it is actively testing a major support zone that analysts have identified between $90.49 and $96.25.
So at 94.97 today, we are right in the middle of that trapdoor.
We are standing right on it.
And here is the bombshell detail that I think is really going to freak retail traders out. Over the last 90 days, insiders at Charles Schwab have dumped 415,568 shares.
That is a lot of stock.
It is. It's worth about $42.6 million.
Yeah.
So I have to ask, if your company just had record revenue, why are you cashing out $42 million?
It's a fair question.
Isn't that exactly why retail traders get nervous? You see the executives hitting the eject button.
If we connect this to the bigger picture, it makes perfect sense why people are scared. You have a technical falling channel combined with massive insider selling.
It's a terrible look.
It creates this deeply mixed to cautious market sentiment. It perfectly explains all this short-term weakness we're seeing.
Okay, so we have a total clash here. We have fortress-like financials on one hand and then just terrible short-term technicals on the other.
Right.
Which sets up this ultimate debate. Is this stock truly undervalued right now, or is it a value trap for retail investors? Let's start with the bear case.
Okay, so the worst case continuation lower is driven by a few things. First, that persistent operating expense growth. Over a 5-year period, they have a 15.2% compound annual growth rate just in expenses.
15%.
Yeah.
Just to run the place.
Yes. And then you add the massive macro risks. We have elevated inflation and intense interest rate uncertainty.
And how does that actually hit their bottom line?
It causes a phenomenon called cash sorting. This is directly impacting their client cash levels, and it's a huge problem.
Right, I've heard of this. This is exactly why retail traders get trapped, right? They buy a recognizable brand like Schwab on a 5% dip, but they don't understand the macro headwinds.
Exactly.
Explain cash sorting, like simply.
Think of it like a grocery store. Historically, Schwab made billions by taking the uninvested cash in your brokerage account, which earns you nothing, and investing it in safe, higher-yielding assets like treasuries. They kept the difference.
Ah, okay, so that was their highly profitable store brand product.
Right. But when interest rates shot up, clients realized their idle cash was earning 0, while a money market fund paid 5%. So they sorted their own cash and moved it manually to high-yield funds.
Meaning Schwab lost all that free, cheap funding.
Yes. They had to go borrow money at much higher rates just to keep things running, which crushed their profit margins.
Wow. So what does this all mean? Because there is a massive contradiction here.
Oh, with the analysts.
Yeah. If the risks are so high and cash sorting is crushing margins, why is the consensus Wall Street rating a moderate buy?
It's pretty wild.
Out of 22 analysts, 19 rated a buy or a strong buy. 2 say hold, and literally only 1 has a sell rating.
They clearly see something the retail crowd is missing.
Right. And the average price target is $116.85. With a high of $135. So what is the bull case?
The bull case, the best case recovery scenario, is that management hasn't just been sitting around. They have actually reduced their reliance on that high-cost supplemental funding by 85% since 2023.
Wait, 85%? That's a massive reduction in expensive debt.
Exactly. And as that expensive debt rolls off the books, it should trigger a huge recovery in their net interest margin, or NI.
Ah, so their profitability is about to bounce back.
Right. Plus, organic growth is just exploding. In 2025 alone, they brought in $519 billion in core net new assets.
$500 billion in fresh money. That's insane.
Clients are still flooding the platform.
Which brings me to one final, really surprising, bullish argument. Schwab is expanding into retail spot cryptocurrency for Bitcoin and Ethereum.
Yeah, what's fascinating here is that this crypto expansion could attract an entirely new demographic.
You mean younger investors who wouldn't normally open a Schwab account?
Exactly. It completely offsets the traditional macro risks because crypto transaction fees are a brand new revenue stream that isn't tied to interest rates or cash sorting.
It's like a legacy giant suddenly learning a brand new trick. So bringing both sides of this debate together, how do we look at the future?
You have to separate the timelines. The short-term outlook is incredibly volatile. It is chained to interest rate sensitivity and that technical weakness we talked about.
So the next few months could be pretty painful.
Oh, definitely. But the medium to long-term outlook remains heavily bullish. Earnings per share are actually projected to grow at a 15% compound annual growth rate all the way through 2028.
Which is the natural human debate of investing, isn't it? Do you stomach the short-term bearish MACD and that terrifying insider selling to try and capture that projected 15% long-term growth?
That's the million-dollar question. You have to decide what kind of investor you are.
Exactly. So to quickly summarize our journey today, we explored their $69 billion cash pile, but also the bearish technicals testing that $90 support floor.
We covered a lot of ground.
We really did. We talked about the $42 million insider sell-off and, of course, this brand new Bitcoin and Ethereum frontier they are pushing into.
It's a completely unique setup.
It is. So, listener, do not forget to like, subscribe, and drop your thoughts in the YouTube comments. And remember, one last time, this was an analytical deep dive, not financial advice.
And this raises an important question to leave you with.
Oh, go for it.
If a traditional financial giant is simultaneously shedding its high-cost funding while expanding heavily into spot cryptocurrency, are we witnessing a legacy brokerage transforming into an entirely new kind of financial institution?
This is a great point.
And if so,
Yeah.
do the old valuation models and historical support lines even apply anymore?